that? That's a very good question. It's explained in the second half of this chapter, which means that I can do this now. All right, so first of all, what is the money supply? I'm going to be probably answering your question over the next 10 or 15 minutes because that's half the chapter. Money supply is equal to whatever the money reserves are, whatever the reserves are in the whole banking system, multiplied by the money multiplier. Okay. So, now we need to say what is the money multiplier. We already said that part. So, the reserves are in two forms. So, the reserves are held in cash. This is just the money that you have at the vault. In other words, when I go to the bank, all the money at the ATM. The money at the ATM belongs to the bank. It's in the form of cash. And when I walk to the bank and ask for some cash, they give me some cash. They keep very little cash on hand. So, if they have a big balance sheet, let's say a whole bunch of loans, okay, and they have a required reserve of 10%, they'll keep in cash no more than 1%. The other 9%, they'll keep deposit at the Fed. How did we call this deposit at the Fed? The commercial bank. It's deposit at the Fed. How do we call it? Anywhere. Anywhere. Deposit at the bank is called Fed funds. Okay. So, Fed funds. Fed funds. Okay. Now, Fed funds, let's repeat and write it out, is a reserve. And now let's just repeat from the very beginning. What is a reserve? It's an asset that you keep. Okay? So, it's an asset that you cannot loan out. You must keep.
You keep, but in case you have bad debt, a lot of bad debt, then can you?
Okay, now about bad debt. Let's do this. Bad debt. What does it mean, bad debt? Bad debt means a debt which cannot be repaid or is not likely to be repaid. In other words, it's a loan which the commercial bank made, but is not likely to get back. Okay? Now, you should have studied this, and well, maybe not yet. I'll be explaining probably later on. Bad debt and loans are a loss to the bank. They are a loss. And losses, just like profits, go where on the balance sheet? There is an income statement. So an income statement, you get the revenues, you're going to get expenses, but you also have profits and losses. Where do profits and losses go on the balance sheet? Again? Capital. Perfect answer. Now, we need to say in accounting, what's the name of accounting for capital? We call this, let me rewrite. The perfectly correct answer, which is how it's called everywhere, is called bank capital. Bank capital. And we call this in accounting, what's the name in accounting for capital? Equity or owner's equity. Alright, well, I've been just just teaching the other students, so I figured that they didn't know why this doesn't move. What are the equity components? What are the equity components? Elements. What does the equity consist of?
Asset, liability.
No, asset, no liability is something else. What are the components of equity?
Paid in capital.
Yes, perfect answer. Paid in capital. Okay, what else? Profit, huh? Profit, loss? Again, I heard it somewhere again. Who said it? Retained earnings. Retained earnings. Retained earnings. Okay. Now, retained earnings includes profits, okay, and losses, okay. So, let's go back. This loss and profit goes into owner's equity under retained earnings. So, now let's write it out. Bad debts, rising debts, lower, let's write it out. Retained earnings, which in turn, lower arrow, okay, lower arrow, which lowers bank capital, okay? Now, bank capital can shrink, okay? So, we call this availability of bank capital. This applies for any business. And you should study in accounting for any business, not just bank. Solvency. Solvency is the ability to service all of your obligations. You're solvent when assets exceed liability. Let's write it out. Solvent means assets greater than liability, which is the same as equity is positive. Is that part clear?
Sure. Bank capital go down.
Yes, bank capital go down and solvency goes down. Okay. Now, next step. Insolvent. Now I'm changing the name. A business could be a phone shop, could be a university,